probably are already seeing, some semblance of a currency crisis, right? You have central banks in Switzerland intervening, whether actively intervening or just through words. You also have it in Japan, and there's always the threat of them intervening. Okay, you're seeing a lot of newspaper stories now about China and the U.S. and tensions there. But to be honest, I think over the next few years, for there to be a real currency crisis, the dollar has to get a lot weaker. And if the theme of deleveraging, which is falling stock prices and a rallying dollar, occurs over the next few years, as I think it will, then we probably are actually further away from that currency crisis than people think. That would be something that happens after the fact, right? So the next few years will probably be like a larger scale version of 2008, in which you get a stronger dollar rather than a significantly weaker dollar. Several years out, I think actually long dollar positions might actually perform fairly well because the correlation between the U.S. dollar and the S&P is basically inverse, right? As the S&P goes down, the dollar goes up. So that's one way to protect yourself. If you're a global equity investor, you might want to look towards currencies and look to trade some of these dollar pairs to hedge your exposure to equities and be a little more worried about declining stock prices at this point, which again can be played through a long dollar position.
So long dollar positions is the best way to protect yourself right now?
I think so, yes. If you're worried about deleveraging in global markets, then that is the best way to protect yourself.
And which long dollar pairs would you suggest?
Well, the highest correlations at this point are actually the euro dollar is one. And again, this is longer term going out, but also the Australian dollar, okay? It's a high interest rate currency, so it does tend to reflect that, that balance of optimism and pessimism fairly well. Okay, as liquidity is provided to the global markets, it goes up. As liquidity contracts, the Australian dollar goes down. It's also a play on China too, right? Australia is a lot of exports going to China, so you can play Australia or the New Zealand dollar.